Good morning, everyone. My name is Sunil, or SK. Welcome to my channel, Forex with SK on YouTube. Today we're doing something very special. I already have 20 podcasts available on Apple as well as on Spotify, titled A Practical System for Trading Foreign Exchange. They follow my book in logical segments. And today what we're going to do is break into each one of those episodes with some practical illustrations, examples, charts, and graphs, so that the concepts that weren't easily understood orally in just an audio podcast become clearer with pictures and images. The purpose is very simple: help you decide if you want to pursue Forex trading through multiple channels. You have Spotify podcasts, then you have this channel which gives you graphs. And if you still want to proceed further, please buy the book, read through it, and then join my classes. Joining us also on this web seminar today is a very interesting group of people. We have a very successful business executive in the US, one of the top 500 business leaders, about to retire and wondering where his retirement income is going to come from. And so he's looking at Forex as an option. Another friend of his with a very similar profile, also wondering about the same thing. They're both adept at investing. They've played around a bit with cryptos and equities, but not quite sure about Forex. So they're still exploring. And then we have another young lad from the US who's also exploring this as a potential career option, not quite sure if he wants to do this full-time or not. Moving on, we have a couple of very young traders who've been trading foreign exchange for the last 3 years for a proprietary trading firm. So effectively, they trade the prop firm's funds for income. And so they're joining the call as well. They're experienced. They've been at this for the last 2 to 3 years. And then moving on into Australia, we have a young lady who's also very adept at investing. She's done a bit in cryptos and in investing. She prides herself on the fact that despite all the volatility in the global markets, she hasn't lost any money investing. And I think that's great. I think that's a terrific achievement, because that's the first rule in investing: don't lose your money. And then another young lad within Australia who actually works with one of the MetaTrader 4 platform companies, a regulated broker who's working on the AI vertical of this company. So a very interesting combination. So let's dive in. And what we're going to do is today we're going to dive into the book overview, the concepts that were covered there, and we'll do it in a bit more detail with graphs and charts.
So you notice the title is Investing in Forex. A lot of people think it's trading. I actually think it's investing, and I'll come to that part of it a bit later. But for some of you who don't know me, I'm a chartered accountant. I'm an MBA in finance from Delhi. I've retired now, but I have a banking background. I was with B of A, Maastricht Bank, ANZ in Australia, and then a nice 10, 12-year stint in Singapore, which is great fun. I started my journey in Forex trading somewhere in 2000. Like some of you, I wanted to retire. And so I started trading in about 2000. And initially, interestingly, I actually learned code. I know programming. And so I designed a whole program in MetaTrader 4 to trade Forex automatically. The results were very erratic. It worked a bit and it didn't after a while. So I discarded it. It was very frustrating because the markets keep changing. So there's a lot of myth around, well, if the system is so good, then, it should just trade automatically. I didn't find that it worked. Later on, I joined Acuity. It's a hedge fund that operates out of Montana. I joined them as a gold trader. So they have a series of tests that they run people through. And you go from bronze to, whatever, silver and gold and diamond to gold. And then finally, I said, forget it. I'll just trade on my own. Why do I trade for someone else? So like I told you all, I have a home right now in India and Australia. And of course, we love to travel. My kids are in Singapore. My primary interest is investing. I invest in global equities and ETFs. That's just a bit of background. Now, before we move forward, I think it's very important that we run through the legal disclaimer. All of this, the content in my Spotify, etc., it's for educational purposes only. It's not a recommendation. You must recognize that trading Forex involves financial risk. It results in significant loss of capital. It can. And you must consult your financial advisor before risking your personal finances in this venture. Trading involves uncertainty. Past performance is no guarantee of future gains. And the views herein are entirely my personal views. I do not take into account your personal financial situation. Also, in international, it's particularly important that you check the regulatory restrictions. So, for instance, India, there are some restrictions on trading Forex. So please check your regulatory restrictions before you do Forex trading, because the laws in each country are different. Okay. Now, why Forex, and why do I deem it as investing and not trading? So, we're looking at a scenario where yield on cash and bonds is at historic lows. There's a lot of volatility in equity markets. And very often I find, I'm part of an investor group, that it creates a pressure. We have a lot of us in our group who pursue yield. And so if a stock is really down, is generating a yield of 7 or 8%, we go ahead and buy it. But guess what? The stock tanks by 10%. And so whatever we thought that we would earn on yield, we lose. And so this low yield environment creates pressure for us to make suboptimal investments. Forex, on the other hand, is a very highly liquid class. And with a correct methodology and a system, it can generate very high returns. So people could generate more, but I would suggest that you take a rough benchmark of between 1 to 2% per week. And there's no lock-in. You can liquidate your positions at an instant, especially if you have a MetaTrader 4. It takes you 5 minutes to get out of the position and go into cash. The system that I follow has been developed over 2 decades. And it has a very disciplined approach. You'll see that as you go through the podcast and you go through the book. There's a lot in terms of risk management. I think that's the key. I think there's a context to risk management that I must explain. I love to use analogies. So one of the good analogies I do is, for instance, what's the first thing you learn when you start to drive a car? You learn where the brakes are, right? You learn where the rear view mirror is, where traffic's going to come from, where it's going to hit you. That's the first lesson. What's the first lesson you learn when you start swimming? You learn how to breathe. You don't learn how to swim first. You first learn how to survive. And that's exactly how we should look at Forex. The first skill that you have to learn is how not to lose your money. And that's why, I said it's a great compliment that you haven't lost any money in today's age. That's a fantastic start, because that's the first lesson in investing and trading. Learn not to lose your money and protect your capital. Now, let's give you a context to why Forex. Now, it'll amaze you to know that the global Forex turnover every day is about $7.5 trillion every day. And I'll put that in context. The global turnover on equities is only 0.6 trillion. So Forex as a market is about 12 times the turnover of equities. Now, if you're, you've all bought equities, so you've already seen what it's like to buy a small cap or a large cap. Take a NVIDIA or take a GE or a Microsoft. Those large stocks, large caps move very little. The volatility in those stocks is very low. But the small caps, the volatility is very high. So you could buy and suddenly be down 10% in 2 days. But that wouldn't happen with a Microsoft or an IBM. And so that's where size matters. The trends move slowly. There's a lot of money flowing. View it like a big, huge oil tanker. And an oil tanker turns, you can see well in advance that it's turning. It's going left or it's going right. Now compare that to sailing the oceans on a sailboat. You could overturn in like just one, like the Flash, just like that. And that's the context you have to bring into investing, especially in today's equity markets. So Forex is huge. It's much bigger than equities. And actually, contrary to common belief, there is far less volatility in Forex compared to equities. And that's what makes trading Forex attractive. You can stay in a trend and leave the position even for a day, 2 days, sometimes even a month without really worrying about that position. Now, obviously, US dollar accounts for 88% of the turnover, and even within Forex, there are segments. So INR, for instance, is not a tradable currency. It doesn't have much volume. So if you do decide to move into Forex, then I would suggest stick with the majors, which is a US dollar to pound, US, euro, yen, and Aussie. But I must caution you, my book and my systems have only focused on the Aussie. Aussie US is a pair that has its own unique volatility. And so it works. Those indicators work. You may find that the volatility on the euro is far more. So please don't take my indicators on my book and apply them blindly to the other pairs. They work for the Aussie, but not necessarily for the others. And Aussie works for me because it gives me 2 time zones. You see, I get up in the morning in India and Australia is open, so I can trade the Australian session. And then I'm chilled for the rest of the day. I can roam around, do whatever I have to do. And by the time I'm back in the evening, the US is open, so I can trade the Aussie US in that session as well. So I get 2 very convenient time zones. As I've said before, cash and bond yields are at sub 5%. In fact, sub 3% now, almost 3.5% for the Australian dollar. And look at Forex as a better alternative to cash and bonds. You can generate a far greater yield. Think about it, it's cash. You can liquidate your positions within minutes. So it's completely like cash. And if you can hold on to a position and trade it, you can make far better returns than you would with cash and bonds. So just to introduce you, this is my book. This is what I've written. This is going to be published soon, probably in the next couple of weeks. And I think September will be the publishing date. So that's a background. It's a practical system for trading foreign exchange. It will be available on Amazon plus the ISBN. I'll run you through a few chapters. So the contents of the book, we cover, the basics of foreign exchange, some trading mathematics. We'll go over this in later sessions. And we start with defining what is a trend. And we'll cover segments of that today in today's session. What is a trend? There are some technical tools. So we talk about Donchian channels, parabolic SAR, MACD, and the Ichimoku system and moving averages. That's it. I'm not a great fan of too many indicators. Get a few tools that are good, effective. Each tool has its own separate purpose. We'll dive into that a bit later. And then we talk about swings. So that's another concept. I think we'll cover that in today's session. We'll talk about swings. And then there is wave counting, and then managing risk and reward. We will cover a bit of that today. So once we've covered these basic tools, we do dive into different trading methodologies. So I do cover very short-term trends, like a 13-hour trend. And I go into larger ones, like you can trade a 5-day weekly structure. How do you trade a 27-day or a monthly structure, right up to a 52-week structure. So depending on the amount of time, your risk appetite, your comfort level, you might be very busy, so you may not choose to trade a 13-hour trend, but you might choose to trade a monthly trend. You can pick whichever strategy suits you out of that menu, if you will. And then I also cover scalping. So scalping is very rewarding. I have a great analogy. When you take your dog out for a walk, the dog goes around, he goes right in front, sniffing around, then you call him back, he comes right back, he probably go behind you, sniffing around, and then again go up front. So on a 5-mile walk, you might only do 5 miles, but your dog has probably done 15, going up and down and up and down and up and down. And so scalping is a bit like that. Every small little squiggle and movement, you can trade it. It's possible. And you can actually generate a return that is far greater than the underlying movement of the currency. It's useful if, for instance, you're coming home one evening, you're having a drink, and you say, "Hey, let's look at what's happening in the market." If you took a scalping trade, you can make your 1% in that one evening alone, and then you're done for the week, right? If your target was 1% for the week, and you made it in one evening over a drink, you're chilled, you're relaxed for the rest of the week. So that's the context for scalping, but you need to be careful. It is very volatile. It is short term. And so you need to really know where you're going. And that brings us to risk management. Then I cover some live trading examples. Now, I was explaining to you about the learning support system. If you do decide to get in, the first thing to learn is, hear my 20 podcasts. They're all on Spotify and Apple. If you search for a practical system for trading foreign exchange, you'll find the 20 podcasts. And they will run you through different segments of the book. Chapter 1 to 3 is a separate podcast. Chapter 4 and 5 is a separate podcast. So you get a very nice paced way of going through different concepts that are already covered in the book. And if your appetite is fine, that's good. Then what we do is, like today's session is a session on the overview of the book. We will record it. We'll put some illustrations. So while podcasts are only audio, in our sessions today, we'll cover some visuals, some pictures, and that becomes part of the same podcast, but that's available on YouTube. So today will be the first session there. If this still grabs your interest and you say, well, I'm still interested, then you can buy the book, go through that. But like I said, you can't fly a plane by reading a manual. So you will need some coaching, some working with people who are already trading. There will be numerous questions that will come up. So for that, I give you a guide. So I have another channel called Forex with SK, where I cover just the monthly trade. So I use the principles of my book, and I give you what is the bias for the current month. And that may be valid for 1 month, 2 months, 3 months, or it may flip. Within 15 days, we can't predict how these trends change. But I'll give you at least what the monthly trend is. And you should be aware what the monthly trend is, because by and large, all the short-term trends are subsets of the main monthly trend. And then lastly, if you really want to get serious about it, you can join me on live web classes. I'll run those. You can email me with your questions, or you can join me on a WhatsApp chat. That's my Singapore number. You can record that, send me a WhatsApp, and I'm happy to help you, support you through your journey and answer any questions. So let's dive in now into the segments of the book, and I'll show you a visual of how this runs. So the first concept that we do talk about is, what are these charts? What do they look like? Yeah. So MetaTrader charts, they basically look at charts as nested Russian dolls. There's a whole series of dolls nests into a chart. So to give you an example, this is a monthly bar. And the green only means that the end of the month closed higher than the beginning of the month. But this one bar captures all the price movement of one full month of data. Now, if you zoomed in into the same chart and you looked at it as a weekly chart, you would see 4 bars. And this 4 bar is nothing but an exact replica of what happened here. But what happened here is hidden. You get a bit more detail here. It tells you that initially you had an up week, and then you had a down week, and then you had an up week, right? So that's 4 weeks within a month. And you can see here that if you were only trading a month, you wouldn't be able to make much money. But if you were trading it with a weekly trend, you could make some money going long here. You could make some money going short here. And you could again make some money going long here. So each weekly trend, which is very important. I think the weekly trends are very, very important. And then further, you can dive into the daily charts. Now so look at this. This green bar here is a representation of this move. These are the daily bars, which comprise this one green bar right here. And then this fall right over here is encapsulated by this red bar here. So the weekly was down, but it was comprised of so many days that were down days. And then you have an up bar, which is right here. So So look, when your stock charts, when you look at your equities, etc., it's exactly the same structure. It's just view them as Russian dolls. You can explode this daily bar into H4 bars, where each bar is 4 hours. I love to trade that. Or you can trade hourlies or 30 minutes or 15 minutes, right down to 1 minute. So it's your cup of tea, how you choose to do it. Now, let's take a look at this uptrend and see how I define it. Now, one of the common fallacies in trading a trend, a lot of people say trade a moving average. I think that's my view. It's completely wrong. A trend is simply a price going up. You can see this here, right? This price is higher than this. This is higher than this. The monthly trend was up. Here, the weekly trend was up. This was higher than this. You can visually see it. Why? Because this ending price is higher than this. And this is best explained by an aeroplane. When a plane takes off, what do we see? We don't need a moving average to tell us if the plane is taking off or not, right? What is it? What are the indications? How do we know? One, the nose is above the tail. And what's most important, the nose is also above the wingspan, the main body of the plane. So if you looked at this plane at this length, notice that this wing is somewhere in the middle, right? So this is a kind of halfway point. So there are two indications of a trend. The nose is above the tail, and the nose is above the midpoint of this plane, right? And I'll explain why these both become important a little bit later. Let's look at a downtrend. A downtrend is exactly the same thing. Nose is below the tail, and the nose is below the body and the wing. So just remember that. That's how I define a trend. And in that definition, therefore, let's take, I go into a bit of analysis and how a trend changes. So think of the pike dive or the jackknife. We all do, we all swim. So here's a diver, they just curl up, they go onto the springboard and they jump into the air, right? Now here they're stretched. Look at the same analogy. Nose is above tail. This is an uptrend, right? The head is above, and the hand, most important, is above the waist. The head is above the waist. So this is the same analogy of a plane. Nose is above tail, and nose is above the midpoint. Both factors are there. Here also it's the same. But notice what happens when the diver starts to take a dive. They curl up right there. And notice that the distance between the tail and the nose is the least here. So this is what I would call a swing point. The diver swings and then turns around and goes down. This is the least risk position for entering into a position. If you're on a long, you've got to be alert to these swing points to be able to know, hey, my long trade is over. I better get out of this because now the market's going down. Okay, and we'll come into some of the techniques how we do that. Let's expand on that whole idea of a swing. Okay, so here, for instance, if you throw a ball from a 50-foot high building, it'll bounce off the floor, the ground. It'll take a bounce, but it'll be lower. So you'll see a series of successive lower highs, lower highs, lower highs. Now you don't see a lower low here because the ground is fixed, right? But in financial markets, the ground is not fixed. So you may see a lower low, you may not. But the only way to tell that the trend is down is to keep watching these. And this is created by two momentums. One is the force of gravity that's pulling the ball down. That force is much greater than the momentum of the ball itself, because the ball comes here and it has a momentum of its own. It bounces. That bounce is not strong enough to counteract gravity. And so you have two forces at play which create this. And that's exactly what we use when we trade Forex markets. We trade with the longer term trend. So here gravity is longer, it's bigger, it's much stronger. So you know that this is a short market. So you take a bounce when it kind of levels off, you say, okay, let me get out of this trade. You wait for a full bounce. When it's fully stretched, you take yet another trade. and you take it down. And it fully stretched, you take yet another trade. And this is the example of scalping. If you were to do a monthly trade on this, for instance, you could take a short here and you'll exit it somewhere here. You'll make money. There's no issue. But if you could scalp this, you could make money here, wait, here, wait, here, wait, and you'd make a lot more money on the same trend if you were able to scalp. Lastly, I covered risk management. Now, you'll find it a bit controversial. Most people in trading literature talk about setting tight stops. My philosophy is no, set loose stops. It's a bit like sailing close to the wind. You know, you're waiting for an accident to happen. If you set tight stops, market volatility will hit you much more often. So my philosophy is set loose stops, don't set tight stops. Keep your risk still within the same elements. What it will force you to do is take smaller positions, but you will stay with the trend. You won't get knocked around by one small price hike. So my philosophy is set loose stops. And here is a framework to think about it. So for instance, if you think about loose stops, medium and tight stops, and you look at risk, if you're risking 2%, 4%, 6%, so your risk is going up over here. In my definition, risk goes up as you get to tighter stops. So here in this situation, what happens? You have a very high probability of your stops getting hit, and you have much bigger losses, 6%. So you say, okay, fine, I'm going to cut my risk down. I'm going to cut only to 2%. So that's a good way to handle it. You cut your risk on every trade to only 2% and you set tight stops. Sure, but that's a medium impact still. Now, if you were to set your risk at 2% and set mid-level stops or loose stops, the likelihood of your stop getting hit is much less, and the hit on your equity is also much less. So you must look at not just the risk itself, but also the probability of that risk happening. Risk always must be looked at with probability to be able to form a perspective. So these squares, they're low probability areas. This is where you would ideally probably want to go, medium, but this is definitely avoidable. Never look at high risk. All right, so those are some of the concepts. You will find these in my book overview chapter. With that, I'm going to come to an end to this, and I'll open it up for any questions.
Yeah, I mean, lots of thoughts are coming to my mind. Let me ask a few things. One of the things is, as you were talking about your discipline of trading and maybe getting into twice a day based on the market opening times. When you think about somebody getting more smarter on this over time and then starting to really trade, is it really required for you to be active in the market for twice a day or once a day, or what's the frequency you would expect somebody who wants to get, let's say, more serious about it?
Well, I would suggest the Forex markets are a bit more responsive to economic events, uncertainty compared to equity markets. So I wouldn't say trade that often. I would say if you're starting to get into it, be aware of the monthly trend at least. So I think, my podcast, Forex with SK, actually describes the monthly trend. And right now I'm bearish on the Aussie dollar, for instance. So recognize the bearish, but then do look at the markets every 12 hours. Just take a glance, get a perspective. And you'll find that within the context of a monthly downtrend, you will have up days and you'll have down days. And I think it's an essential skill to be able to recognize when the up day has ended and when a down day has ended, because those are the spots where you start to take a trade. So it's a skill. I find a lot of new traders, they get challenged, so they're going, so here it is, okay? Let me take the same bouncing ball philosophy. Let's say a football comes from high up in the air, it's being passed to you, and you're out there shooting a goal right in front, yeah? Now, when you take that ball, you take it at full toss? Probably not. Most skilled football players will wait for that bounce and immediately put their foot on top so that it stops going up. That will give them full control. That means knowing when the ball bounces on the floor is crucial, because that's when you know that the downtrend has ended, and it's great to get into play at that point in time. Otherwise, you have no control. Some players are more skilled, so they might take the ball at full toss. So for instance, if you're shooting a long corner, you can take the ball at full toss, turn around, Pele style, and shoot it right into the goal while it's in the air. You can do that. And this is very personal. While I've written a book, I know a lot of the techniques. I'm not a trader. My personality is completely against being a trader. I'm such a risk-averse guy. You wouldn't believe it. Yeah. And I think this is an important thing to remember. Ultimately, your success in trading Forex will be your own personality. You can read hundreds of books, you can go into hundreds of YouTubes, but whether your personality allows you to be a successful trader or not is your own personality, nothing else. I can put two people together, read the same books, have the same system, the same methodology, and they'll end up after a month with completely different results.
From what I understood, do we have to first read the book and or listen to all your podcasts in Spotify before we can move on with next sessions with you, so that we have a foundation, or we can start joining your sessions while we are working on the podcasts and the book?
So let me explain the context a little bit in more detail. So the book contains everything. So certainly in order to go on this journey, you'll need the book because that has all the text. The book will be out literally within, I think, another week or 10 days. So that's not a problem. My sessions are a bit different. So here, what I'm doing is I'm exploding into each concept. So you will find today's structure. I've covered concepts that were there in my first podcast, and I've explained them with a few illustrative examples. Now, if you're attending this session, I'm happy to dive into any of them in more detail and say, well, I don't really understand that. Show that to me on a chart. And I'm quite happy to do that today. Yeah. But that little piece will not be recorded and it will not be posted on YouTube. So that little dive in, even if you choose to spend an hour extra and say, no, I want to understand this trend concept, show it to me on a chart, show it to me the Aussie dollar, I'm happy to dive into those. Those are only for people who are joining my session live, like right now. Once this session is over, we are not going to go through that concept again. For people who missed that session or who are only into YouTube and want to go into detail, they'll have to join me on a private web session. Yeah, so I'm going to do these regularly, once every week is when I propose. In my next week's session, I will cover the second episode of my podcast. I'll dive into that in a bit more detail. I'll give you a few more illustrations. And if you haven't understood those, then I'm happy to dive in more detail and elaborate on that. Mostly, you will find that the first 6 or 7 sessions will be enough. You can look at YouTube as well, because I'm covering things like technical indicators, moving averages, just with a different spin. And the book and our sessions will be more than adequate. So I don't know if that answers your question. So if you do decide to be on this journey, then please join me every week on this podcast. And yep, we'll explode it. As soon as my book comes out, then you can get a copy of the book and go through that, read it. And these are not new things. You can also look at YouTube, elaborate on concepts. If you have a new concept that you've discovered on YouTube that you don't find in my book, or there's a conflict, then I'm happy to answer those questions in our session, in our weekly sessions.
Okay, so what I made is make out of this is that attending your sessions is good enough, but if we listen to your podcast and all, then that's icing on the cake. Is that correct?
It's the other way around. The podcast is actually good enough to get your concepts right, because they just explain to you. The
Mhm.
icing on the cake is to have me explain the podcast and go through illustrations and diagrams if you haven't understood from the podcast what those concepts were, right?
Okay.
And then finally, if you really decide to put real money in and trade, then I guarantee you, you will not be able to do it simply by the book or the podcast. You will need to have some private lessons as well.
Sure. So I guess like before our next session, it would be worthy to attend, like, at least listen to, at least a few of your podcasts. Maybe like you have 20 podcasts, so maybe we can listen to 1 to 3 or 5. I don't know. Maybe if you can
No,
suggest.
no. So the structure is very clear. So today's session is only about the book overview. So 3 or 4 concepts. Now, these are orally described in the podcast, but the podcast would never be able to explain the concepts to you the way I did today. So
Sure.
today is about the visuals and the illustrations that accompany the podcast. The podcast is just audio. So if you had come into the session today after only hearing the book overview, then this would have been enough. You would have understood exactly what the book was talking about or the podcast was talking about. So for the next session, I would suggest just hear episode 2. Right?
Okay, the
Okay.
podcast too, right?
Podcast episode 2. Just
Yeah.
hear that. If you're interested, go further up and listen to the others. No problem. But in the next session, I will explore episode 2 in more detail and answer any questions that you have.
Okay.
Sure.
So if I would just play back, the way I'm thinking about this is every session like we are having today going to link to the one podcast each? So let's say we finish the second session on Excel, and then we will listen to the third podcast, and then we'll come into next Sunday after that, and we talk about third. Is that like a direct correlation? And how does that correlate to the chapters in the book?
Well, the podcasts are actually excerpts from chapters of the book. So the first
Each chapter is each podcast, is it?
almost. So
Almost.
and sometimes I group them. So if you think about the second chapter that you might want to listen to, it covers the first 3 chapters of the book.
Right.
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 And then chapters 4 and 5 will probably be podcast 3. I don't remember exactly, but that's the progression with which the podcast goes. So it is very carefully structured. So the podcast number 4 will only be covering probably the first 30 or 40 pages of the book. It won't even discuss, it won't touch on any of the more advanced concepts.
Okay.
So it's a progressive learning skill.
Got it.
Okay.
All right. I mean, people have more questions. I do have 1 or 2 more.
Yep. Go ahead.
So just thinking intuitively, 1% return a week is a 67.7% return per annum. That's phenomenal, right? So obviously, why would anybody want to do anything else than do this only? Right. So,
Okay.
I mean, there has to be some catch here, right? What's the catch?
Yeah. Okay. So let's get back to why I called Forex investing and not trading. So if I look at my investment portfolio, 98% of my portfolio is stocks, ETFs, and equities. Only 2% of that portfolio is Forex. Right? So think of your trading activity as a subset of your portfolio. The trading activity is your dog taking a walk. It's producing far more than equities would do on average. So if you think of, let's take the S&P 500, all right? We typically per annum on a compounded 10-year basis, the S&P 500 generates about 12%, 12.5% per annum, right? Now, if you were to leave your money there passively, you would make 12.5%. But if you did say, well, okay, I'm going to put 98% of my money there, and I'm going to put 2% into Forex, you will actually find that you might actually end up making 3 to 4% per week as you get more and more skilled at it. Yeah. So while 1% per week is the initial suggested target, in actual fact, you might find 1% per day is well within your reach.
Okay. So
Yeah.
I mean, it's very counterintuitive, like in terms of portfolio strategy. If a 2% of your portfolio is giving you, let's say 67 or 70% return and more based on what you just said, why would you put 2% only in that portfolio?
Because it's high risk.
Okay.
Risk goes hand in hand. So take even your equity portfolio. Yeah. Why would you? Okay, let's take another example. Let's take just equities and think about your equities allocation. Would you, let's say, put 98% into India and only 2% in the S&P 500? Yeah. Well, India does well. Okay, maybe it's not a good example. Maybe,
Right.
yeah, but you get the point.
Yeah.
So risk and return go hand in hand. High returns does come with high risk. I'm not kidding you. Forex trading is risky, but so okay. Let's take another example. A fighter pilot. Yeah, it's risky, right? He's flying at supersonic speeds, all of that, but he has the skills to do it. He doesn't consider it risky. He knows, he has the skills, he has the expertise to be able to manage it well.
Yeah.
Forex is exactly that. If you learn the skills and if you have the expertise, you can control it, you can manage it, and you can manage those returns. Enter into it unprepared and you will lose money. So I think that's the context. It's high return, but high risk as well. You would not put 100% of your equity. Now, if you get adept at it, yeah, you might say, well, I'm going to increase my Forex allocation from 2% to maybe 5%. But I would say take it in steps. Whereas in equities, it's not within your control. What will happen to the global market? What will Trump do next? Where will a war break out? You have no control. Whereas in Forex, you have complete control on what you do. So you're a master of your own destiny.
Right. Yeah, I have more thoughts and questions are bubbling, but nothing as important right now. So I might just ping you on a separate message. But this has been really an eye-opener for me to start off, and enjoyed the session.
Thank you very much. Thank you for joining.